Hey guys, Joseph once again here. Today I want to talk about some different chart types. Now, as you guys can imagine, there are multiple different types of charts that we can use. Some will of course have benefits, others will not. So let's go over a couple and what I use for my trading. Well, regarding the different chart types, you want to pay attention to the four majors. These are minute bars, tick bars, range bars, and volume bars. Now, of course, there are all kinds of different, from Renko to Heikin Ashi to, there's so many new technologies coming out that allow us to manipulate the way in which price action is displayed in our charts. So without going into too much detail, run a Google search over that and you guys probably can get more information than you will from me here. But regarding the four majors, of course, minute bars are going to specify the amount of time that every bar takes to form. So minute bars, if it's a 1 minute chart, you're looking at 1 minute of a specific amount of time is used to generate each bar. So each bar is worth 1 minute of time. Then of course you have tick bars or tick charts. These are the number of ticks or the number of trades per bar. And tick bars are not to be confused with range bars, which is the next. Now, range bars define a specific range of price per bar. Alright, so even though tick bars sound like they should be the same as range bars, they're not. The word tick is referring to trades, not a tick as in the smallest increment of price. So make sure you're aware of that. A tick bar is going to identify the number of ticks or trades per bar. So a 1,000 tick chart means that each candlestick is displaying 1,000 trades that occurred on that particular market. All right, so that takes time out of the equation compared to minute bars. Range bars are very similar. No time involved here. This is going to specify a specific range of price per bar. So for example, this is done in ticks as well. So if you're looking at a 6 range chart, that specifies 6 ticks of price per bar. So if you're trading the DAX and it ticks in half-point increments, then a 6 range chart would mean that each bar has 6 ticks of range, which would mean 3 points. 3 full points on the DAX. If we were looking at a 4 range chart of the S&P, it ticks in 4 tick increments or quarter point increments. Therefore, a 4 range chart would mean that each bar equals 1 S&P point or 1 E-mini S&P point. All right, and then the last one is volume bars. Pretty simple. This is the total number of contracts traded per bar. So 1,000 volume bar would mean 1,000 trades were made to close out that bar. So only one of the four actually uses time as one of its variables. Tick bars do not, range bars do not, and neither do volume bars. Alright, now a lot of people have asked me what I use in some of our examples, what I use in my own daily trading. I've really warmed up to range bars, and there's a couple specific reasons why. First of all, it allows me to manage my risk on each trade. Do me a favor, take out a 1 minute chart or a 2 minute chart, whatever, and compare it to a range chart. Now, if we're looking to take trades where our stop or our initial stop is placed at the extreme of the other candlesticks, whether it be before, after, wherever. Alright, so if we're using price action as a way of placing our initial stop like we do with the James Wave, we want to make sure that we're using a chart type that allows us to easily do that. Right? So for example, if we're looking at limiting our losses per trade to a maximum of $500, let's say that you never want to take more than a $500 stop, well then you can easily use a range bar type of strategy where we're placing our initial stop, right, 2 or 3 ticks above the high of the previous bar. Well then you can always make sure that that level will never put you at more risk than $500, depending on how many contracts or which market you're trading. Right? Whereas you can't do that with a 1 minute or a 2 minute or any type of time chart. Because if you have time in the equation, then you could have one candlestick could be 20 points in range, and the next candlestick could be only 4 points in range. But if you're using a range bar, then we know every single candlestick that closes will be the specific same amount of range. Or if we're using it to manage the risk on our trades, we can then use that by saying we can then put our stop at the extreme of the previous bar, knowing that the previous bar at all times will never be larger than whatever your specified amount of range. All right, so it really helps you manage the risk on each trade. And of course, that's done in conjunction with your trade plan. All right. The other reason is it gives us much cleaner patterns to work with. Clean patterns, I mean, we're not looking at as much of the slop and the chop that comes along with time-based candlestick charts. Right? If price goes nowhere, right? If we're dealing with a very slow market, well, a 1-minute chart is going to keep running 1-minute candles the whole way, which will make it look very sloppy. It can really bog down your charts and make patterns a lot harder to identify. If you're looking at a range chart, okay, using range bars, then you're going to be able to specify whether it be 4, 6, 8, 13, 21 range, right? Whatever we specify, well, that's going to produce bars whenever price moves. So if price wants to sit there all day and do nothing, it's not going to slop and chop its way like a 1-minute or a 2-minute or a time-based chart would do. All right? If price doesn't move, neither does the candlestick. So it's going to give us much cleaner patterns. And you'll see once you compare back and forth between a 1-minute and maybe a 4 or a 6 range on something like the S&P or the DAX. And then most importantly, obviously, it removes time from the equation. I personally don't really understand why time was ever placed in the equation. It really has no bearing on what we're looking to do. If you know how to read the tape, if you know how to watch those footprints, right, pay attention to that time and sales window, use your filter to filter out only the largest traders, right, using those 2 time and sales windows. All right, well, we shouldn't need time. What we're looking for is the speed of the tape to tell us when the participants are acting in the market, and that tells us when we can get involved, right, among other things that our rules specify. But removing time from the equation cleans up our charts. It makes it so that all the patterns look cleaner, and it helps us manage our risk a lot better. All right, guys, let's see really quickly. Very easy to select your range bars or any other type of interval for your chart settings. Just go up top to your NinjaTrader control panel and go to File, New, then select New Chart. Once you bring up your new chart, you're going to get this Format Data Series window that will pop up. And of course, select what the instrument is. This is the FDAX, the number of days back you want to go. Always want to use a minimum of 5 days back. And then set up your interval settings. Maybe you're looking for a 6 range. Use that drop-down box right there to select the range bars. Or you can select minute, tick, volume, whatever you guys would like. All right. I hope this helps you guys identify the different types of charts that are out there. And it's going to take a little bit of playing with it because your own personality will tell what type of chart you're looking for. But just so you're aware, I use range bars or range charts because of those clean patterns they develop. It helps me manage risk on my trades, and it removes time from the equation. All right, guys, I hope it helps.